Hi, good afternoon. Never easy to run a session immediately after lunch, especially when lunch lasted for so long. But great to be here, and I think the previous sessions were actually quite enlightening in terms of the kind of issues that got discussed. We are here as the session got introduced to discuss the role of money in building any new sector, and EV is no different. Obviously, we've seen how a lot of newer industries actually have got built out in this country over the last decade or so, and here we have one more right in front of us. So what I intend to cover as part of this panel discussion is to look at the role of financing in a little more holistic way for this sector. And as we all know, there are two ends to the importance of financing. One is really the consumer end, and how do we make consumer buy and access EV products a lot more easily, and that's really where the role of consumer end of financing kind of comes in. Other is, as we all know, this industry is still at a fairly nascent stage at this moment, where a lot of companies are actually sticking their neck out to develop technology, take risks with newer products. Technology curve itself is kind of fast evolving. They need a lot of funding, and obviously many of these are startups not making money. So how do we sort of help this ecosystem have access to capital to really ride this whole wave and make sure that they actually have products available and the entire ecosystem available for EV adoption. So let me start with the consumer financing part and why it is important. As we all know, this segment, which is basically the automotive segment, is significantly dependent on consumer financing, right? If you look at India, the overall, at a sector level, automotive sector level, our ownership is driven to an extent of 75% plus financing. And you kind of really double click on it, you realize the moment you go to commercial vehicles or you go to, let's say, four-wheelers, for commercial vehicles, 95% of vehicles are actually financed, right? Maybe for four-wheelers, the number is closer to 80%. At an industry level, we are at 75%, and we are the largest, or maybe the second or the third largest country at a global level that actually requires financing, right, to a level of about 75%. Here we are looking at a new product with not much of proven history of performance, resale, which we'll typically define as track record, right? As a result, clearly there are challenges in terms of financing this kind of a product. And there are a whole host of issues. One is the obvious one, which is really, are there enough people or, banks and BFCs, again within banks, public sector banks or private sector banks, are there enough lenders out there who understand this product and are willing to lend to consumers? And second, the cost of financing, because obviously all of this from an underwriting perspective gets reflected in the risk that they attach to this kind of a product. As a result, the kind of rates at which to get these loans is much higher. And third, not to be ignored, LTVs, right? I mean, in traditional ICE vehicles, I mean, you can almost finance 90% plus cost of vehicle. In this case, it's not easy to get loans to such a high level. So let me start with that, and let me pose this question first of all to Koushik. Koushik, as we kind of think about consumer financing, right, and specifically in the context of the challenges I laid out, not having enough lenders or institutions who are willing to lend, higher cost of financing, and lower LTVs. And then you sort of look at the government's vision of 60% plus adoption over a period of time, penetration across different types of categories of vehicles, including commercial, four-wheeler. I mean, how do you see this, and how do you see the two ends kind of really coming together and making that vision really work, purely from a consumer financing and therefore adoption perspective?
So hello everyone, good to be here. So I believe that EV financing is probably one of the most critical levers and at the cusp of that inflection point which can enable EV penetration over the next, I would say 18 to 24 months, right? When we look at the entire EV financing space, the consumer financing space, I think there are a couple of challenges. One, the lenders are not very familiar with the technology or the product. They have been financing a certain collateral for several decades, and the technology changes. They are not very familiar with that. And second is the product itself hasn't gone through a full life cycle. So the longevity of the product, the way it will behave itself is a little bit of a black box for the lenders. What we are seeing in the lending space is actually very similar to how the OEM space is also behaving, where you see some of the bigger ICE vehicle lenders be a little more passive, thinking that the critical mass hasn't been achieved. And you see some of the non-vehicle financing, NBFCs, financing institutions actually trying to understand the space more proactively, try and create products around EV financing and taking the lead. I think that this would be the group of guys who would probably be the first movers and leaders in this space. And I'm very hopeful that they will be the guys who would lead this change from probably a sub 20% financed market to at least a 50-60% financed market over the next couple of years. So that's how I'm looking at this space.
Sure. Aparna, if I may just turn to you, and you've had some experience from banking perspective as well. Now, we all understand that, look, I mean, these are large institutions that have been built around processes, right? And they have well set underwriting processes for vehicle loans, for instance, right? Now you, like what Koushik said, like what we all understand, here is a product that actually doesn't have much of history. It simply means in a banking parlance, there's not enough data, right? And therefore, you know, how do you see some of the legacy banks or institutions really deal with it? And my related question is, therefore, do we believe that some of the legacy banks or institution possibly may just lose out on this opportunity because they're also taking too long to understand how to do underwriting for a new type of product category, and therefore are we likely to see some disruption even on the front of these institutions?
Hi everyone. Hello.
Just keep it closer to you.
Hello. Hi everyone. Thanks for the question. I think you're right, the way the banks are set up right now, not a lot of them are doing EV financing, and we are seeing small pockets of NBFCs trying to take the lead and do the EV financing and pave path for it. The financing in this sector is not like a traditional financing, it's a lot of tech as well. The asset class is something which is new. The track record of the consumers is not established, and therefore the risk, the tech around it, I think all these processes are going to take a bit long within the banking ecosystem to evolve. And right now, the way the market is working is that a lot of these banks are lending to NBFCs and who are on lending to consumers. So this is how the value chain of financing has been operating. I also do see a role of DFIs like us to actually establish directed lending facilities through either banks or established NBFCs to specifically do EV financing. So yes, that is one way to bridge the gap, just like the questions which you asked just now. However, that also has a lot of challenges in our experience. We did try to tie up with a few leading NBFCs to just do EV financing, but the demand side forces were a challenge because the volumes are not big enough. There are industry-wide challenges which are coming up in terms of batteries catching fire, the inflection point still being a few years away, and therefore people not wanting to allocate resources to specifically EV financing. So I think various players in the ecosystem, like the DFIs, the banks, as well as NBFCs, would need to come together to enable this to happen.
Sure. Arpit, if I can just direct maybe a related question to you. I think, as Aparna said, and we've already seen some structures like that where there's a pool of capital which is coming through sources of low cost of capital, kind of maybe through a DFI route, or even could also be, let's say, carbon neutral pools. There are different ESG capital pools. Any examples or suggestions or thoughts that you have where some of those pools of capital, which actually have a mandated deployment towards this cause and therefore have a lower cost of capital, can be made available to enable larger adoption?
So clearly, Manish, in this world, quantitative easing or not, capital is not in short supply, right? So let's start with the assumption that capital exists. So let's talk about what is the capital going to do. Is capital chasing this opportunity or that opportunity? Ultimately, it is an allocation problem. You will realize that there are people who, and let us say people who are doing auto sector financing. Amongst the auto sector financing, there are some institutions like banks which are looking at in an old school manner, and they have been doing this for a long time. Plus, their business models do not allow doing what is otherwise called as product risk financing, where product is not clear as yet. There are so many various methods by which you can, of course, mitigate the product risk, but it is not something that they do. Long time back, actually not too long back, 5-6 years back, used car financing and now used bike financing were not happening, right? And at some point of time, the market became mature enough that banks had started to take a bet on it. It is still costlier than new car financing. And some such thing is obviously bound to happen once the market matures. So in some sense, this part of the market is going to lag behind whatever the actual market on the ground is. So therefore, cash flow will not be available, and therefore their financing will not be coming in spades until there is a stick or a carrot saying PSL. Okay, when PSL comes, you will have to do a certain amount of your capital allocation to this sector. The other piece of capital is, of course, the individual capital. You'd be happy to know there are 200 crores deployed by a company called Grip Invest. Half of it is deployed in EV sector. It is funding so many of these companies. I don't know whether Akash is still in the room or not, but half of their, I'm told a large part of their fleet is financed by Grip Invest. I know our company, Euler Motors, is financed by Grip Invest and so on. So individuals are ready, but then individuals can only do so much. It's not institutional. The third piece is, as you mentioned, could be an ESG capital, could be a DFI, could be someone who is mandated in this sector. Their challenge, unfortunately, is that they don't understand this deeply enough. So they will need to have someone who executes it for them. And that someone who, let's say, manager like us, will have to build something which is at scale, which they can use. For example, let us say, just putting a random name out there, let us say there is some DFI, just to name a DFI. This DFI has a need to do $2 billion of EV financing. They're sitting on the side, but they can't cut less than 50 million checks. Who is the right audience? It's not going to be Shriram Auto Finance, who can take, because they don't have capability to EV financing. Who is the right audience who can deliver, which can build a vehicle where they can deploy 50 or multiples of 50 million? It's very hard. I'm sure BI has the same problem. It is not in this scale available as yet. What is going to happen eventually is, at some point of time, some of the smaller guys who are literally begging, borrowing from various pools will scale up and will be available, will make themselves available at the ticket size that a DFI would be interested in. Maybe an IFC, maybe a GIC, maybe a BII, maybe a CDC. sorry, maybe other institutions, ADB, World Bank, etc., would then come in. But till that happens, capital will continue to be under constraint. This is, sorry, a long answer, but this is going to happen. It's a matter of time, but I don't see a solution happening in any quick succession. In any case, my sense is out of about next 12 months, we will see a lot more solutions emerging at some scale.
Got it, got it. Thanks, Arpit. Just shifting gears to now funding for the companies that are doing the hard work of either making the product available or building the ecosystem, whether it's charging or battery, so on and so forth. So Koushik, I mean, you deal with a lot of early stage to high growth companies. Now, as we all know, look, you're dealing with lots of uncertainties here. There's a product tech curve that you have to kind of manage. On the other hand, these are young companies, not much of credible track record behind them. Obviously, you know, they're not making money today. So what are really the options for companies like these to raise capital? Because clearly, if some of these projections that people are talking about or the government has aspiration to achieve, you know, people have to actually put that money to work, and they can't access banks today because they don't sort of qualify to get bank financing. So therefore, equity possibly is that option, which you know, as we all could think, maybe is that risk capital that can actually support that entrepreneur in building that business. Now, what are some of the challenges that you have heard or you have sort of seen from the perspective of these entrepreneurs who are trying to ride this wave?
So, Manish, we started covering this space in 2018, right? And back then there was a long list of challenges and questions that they would face from the investors. Many of them have been answered, you know, already. So I can tell you 3 things that have happened in the last 2 to 3 years, which used to be existential questions, you know, in 2018-19. One, no one questions the adoption theory now. I mean, back then we were struggling with whether we will reach 10% in 5 years. Now people are talking about 50% plus penetration in some of the vehicular categories, 2-wheelers, 3-wheelers, right? And there's some bit of consensus building there. So investors don't doubt that much. Secondly, India as a country has become extremely comfortable with unprofitable businesses, right? Not just because of the EV space, but how some of the new age areas like e-commerce, fintech, edtech have created value despite not being profitable for their shareholders. And the third thing is a general you know, supply constraint being removed because of multiple pools of capital around ESG, impact funds, etc., coming up in the last couple of years. Okay, so these are good things that have happened. 2 challenges still remain. One is, especially in the OEM space, a perceived notion that the incumbents will suddenly become very active and pour in capital, which will be hard for new age entrants to match, right? And the second challenge is lack of technological differentiation in some categories of EVs, especially in lower vehicular segments. Having said all of that, I think now we are seeing equity capital being much more forthcoming than what it was 3 to 4 years back. The deal flows have moved from $10 to $20 million being raised in Series A in large numbers 3-4 years back to people now raising $30 to $50 million with a handful of 100 million plus kind of deals happening. And now it will move to, you know, 100 million plus deals happening more frequently over the next couple of years. So, you know, they are moving in phases. The other pool of capital that is becoming a little more relevant is venture debt, where at least 3-4 guys have, taken small bets. Obviously, the pool of capital there is much smaller than what you have in equity, but at least for some bridge financing or to at least tackle the timelines that are required for a typical equity financing process, which is 6 to 9 months, that could be a viable alternative. So these are coming up in meaningful ways, and we are hopeful that over the next 2 years there will be many, many more businesses which have scaled up to a level where they can absorb higher checks.
Sure. Arpit, I mean, you guys have obviously taken some bets in this space at a fairly early stage. Now, as we all know, if you see it on the product side, a lot of these products still are evolving, right? And they are kind of establishing themselves for specific use cases, right? Whether it is two-wheelers, whether it is three-wheeler or LCVs. Now, when an entrepreneur or a young company sort of approaches an early stage investor, right? For all practical purposes, there is a prototype maybe somewhere, but a lot of paper, right? Which is kind of talking about this is the kind of adoption we can drive. How difficult it is for an early stage investor to build conviction around a product-centric business model, right? This is different from e-commerce, it's different from fintech because, you were changing the way consumer was getting served. But the product was still the same. I mean, that consumer was still buying the same, a brand or let's say the same soap. It was just a channel. Here you actually are giving the product itself is changing, right? And how are you guys developing that comfort or confidence? And I'm sure when a lot of these entrepreneurs approach you, what is it that you look for that gives you confidence? And again, any learnings that you want to share with the audience here?
Hi. So, EV sector is actually quite dynamic. It doesn't only have OEM businesses. There are charging companies, swapping companies, software companies, financing companies, mobility companies. There are at least maybe 70, 80 companies that we have met, maybe 100, and there are at least 300-400 people that we have not met. So this is a very large sector, and therefore product is a part of it, significant and more visible, but still a smaller part of the entire thing. Among the OEM business, I'm guessing the question is about, we are realizing, and we are investors in Euler Motors, so obviously biased towards them, and we have seen products or all kinds of which happening. And Euler has started very humble beginnings. We invested in this company 10 crore rupees about 3.5 years back, and since then the company has done exceedingly well. They've proven their mettle, and they are doing 4.5 years back, and they're proving their mettle. They're doing quite well. Multiple learnings. One is, product is inherently very hard business, as you said, obviously very hard business. It is very important to focus on robustness because Indian consumers have exceedingly high expectations on load quality, how much load I'll carry, the bad road conditions, our temperature is very bad, and the vehicle should last. There are people, and I'm sure enough people in this audience, who have a 10-year-old vehicle, it's an Activa somewhere, a Hero Honda Scoot somewhere, or a Maruti Swift somewhere. I myself drive a 13-year-old car. It still works beautifully. Like I was driving it today morning, right? And how does it work? It's so hard for someone to imagine building a vehicle. 13 or 15 years later, it's still working in reasonable condition. So it is a hard business. At the same time, once you have built a product, the beauty about the product is that it will sell by itself, right? Once you have seen a product, it will work out. So 2, 3, 4 learnings. One is, you cannot compromise on the quality because that is the only thing that will matter. Quality has multiple aspects. Robustness is very important for the auto OEM business. Second, in the EV business, it is also important to be ahead of the curve on the technology that you're putting inside it. If you are copying from someone, or a lot of people are bringing from China and elsewhere, the kits, you will not be able to have long-term differentiator in your favor. So we strongly believe in having an own capability. The third important learning is, if the ecosystem does not exist, build it for yourself. It is incredibly hard what Euler has managed to do. They set up their own charging, they set up their own logistics, they set up their own driving training. They service their vehicles. Nothing exists. and they have to do it on their own. How do you sell vehicles without it? So if you have to do this, unfortunately, an entrepreneur will have to do it. Now, thankfully, a lot of things exist. So maybe path is easier, but then competition is dramatically shot through the roof. The fourth piece, and I think it's also a case in point, that financing and people who finance also have the same question. But my learning has been that product actually does not matter to me beyond the feedback from the customer. So theoretically and dumbing it down really, but for me, an oiler vehicle and an app inside my mobile phone is very similar, because as an investor, I'm only looking at how the customer is interacting with it and what numbers are coming in as the aggregate. The problem is when I invest into a business where product is not yet in the hands of customers. That is a hard thing. We honestly don't want to take that kind of risk. Most investors will struggle. But once it is out there, you can ask a number of people, take feedback and invest. So it is relatively easy that way. But all of these four things, only when the customer sees your product, uses a real customer, uses your product and gives you feedback and comes back to buy more, is when you know the business is working.
Got it. Aparna, as we have seen, some of the EV companies are scaling up on the back of, what you could call as a licensed tech, right? I mean, accessing the tech could be in different ways. They may have acquired a business and sort of got the tech. But yeah, I mean, they really haven't invested in their own technology. They don't really have much of a prop tech. As a larger investor, as an investor who obviously, has to kind of go through building conviction on scalability of the business on the back of some core moat, right? Some moat or some angle around what could actually see it through, not for your investment horizon, but also maybe far, far longer, right? How do you sort of see that dichotomy when people are trying to sort of raise hundreds of millions of dollars of capital or multiples of that, and maybe when those proposals kind of come to you?
Yeah, very interesting question. Yeah, hi. Very interesting question. We have seen that in most of the models that do come to us, once we dig deeper, we realize that actually much of that is not in-house technology, or they don't have their own in-house R&D as well as IP, and therefore I think valuation expectation is something which needs to be in line with what the technology is. I think that is a challenge that we have seen across the board. And I guess for models which are based off licensed technology, that could be a valid business model as well. However, we would still normally want to see proof for commercialization, path to sustainability commercially, as well as having strong supply chain networks, dealerships, strong distribution. I think that that still needs to be a place. And it is, again, very hard for some of these companies to build that from scratch and then to also compete with incumbents who already have strong dealership and supply chains. And when they come in a big way in the EV ecosystem, the competition and the moat actually is very less. So I do see challenges, in these business models. And as things evolve, we just have to see the competition with the incumbents as well, and what the USP of that company is, what is the moat. If there is enough moat, then I think financing for such models would be easier.
Manish, I have a point to make here.
Sure.
On the licensing bit. See, there is a difference between collaborating and licensing technology and taking a product which is built for some other market, just adding incremental value and selling it as a repackaged product. I think done well, licensing collaborations can work beautifully. The entire ICE market in India is built on licensed, a lot of licensed technology, right? All the big tie-ups starting from Maruti Suzuki to Hero Honda, right, were built on collaborations. And they were the, really the foundation of the ICE market in India. I think it's really horses for courses here, right? A deep tech battery company might want to collaborate with uh, a manufacturer who has the capital, right? Because manufacturing cells take capital, and someone who's focusing on R&D, deep tech, someone like a Log9, for example, right? I mean, they are really good at, innovating around tech, but someone else could be good at providing the capital for manufacturing, right? So those kind of relationships could work well. Uh, I think, adding to Aparna's point, I think what we have seen till now in some of the smaller vehicular categories specifically is people uh, trying to use products from other markets, and doing very incremental innovation on that, which might or might not suit what we need here in India, right? So I think that is where the lack of technological differentiation comes through, which really lowers the entry barrier for that particular business.
Sure. But Koushik, maybe I'll continue on this thread, and maybe I'll request you to also just answer that. Now again, I mean, even as consultants, when we are looking at businesses, either on behalf of sponsors or other companies, I think the key question continues to be differentiation. I mean, from a distance it appears, and again, I'm just right now talking about OEMs or the key products, but again, you could extend the same thing even to other pieces of the puzzle, especially on charging. And now, in a market which is, two-wheeler is a good example, maybe three-wheeler as well, which is increasingly becoming crowded, entry barriers seem to be kind of reducing, adoption is picking up. How do you solve this problem of differentiation, and therefore for somebody to kind of believe that this company can actually withstand, the onslaught of, let's say, either a deeply funded company or a large legacy incumbent kind of coming in a space which lacks differentiation? I mean, first of all, do you agree that there is a problem on that count? And if yes, then how do you think about it?
So it depends on which end of the market you are looking at. So I'll take the example of two-wheelers because you mentioned that. So it's very distinctly divided into two parts, right? High-spec vehicles which cost above 1.1 lakh, and then you have the low to mid-spec vehicles which are sub 80,000 price point vehicles, right? The modes are very different across these two parts of the market, right? In the high-spec category, the modes are product specs and performance, right? In the low to mid-spec category, the modes are brand and distribution, because the product is pretty standardized. You won't have people innovating around technology. They could innovate around efficiency, they could innovate around their own production processes. They rarely innovate around technology. So over there, it's a slightly more mass market product. Over there, you build differentiation through creating a trust around your brand and increasing your distribution, right? Whereas in a high performance, high tech product, you could have some experience centers and even try and go D2C, right? So the modes are very different depending on which part of the market you are playing in. It's very unique to lower vehicular categories. The higher you go up, right, the ability to not innovate goes away. You won't find four-wheeler guys who buy CKDs and just, assemble here and sell. I mean, you have to build the product from scratch. You won't find bus manufacturers, not creating a product from scratch. So the higher you go, the option of not focusing on product development just goes away. So we will see this particular characteristic in the two-wheeler part of the three-wheeler market for some time till the leaderboard kind of settles down. But we won't find this in the higher categories.
Understood. Arpit, maybe you could sort of respond to it. I mean, I recently met a sponsor that typically does Series B onwards kind of investment. And there was a very interesting company in EV that they were evaluating. And somewhere they made this comment that, listen, this is a deep tech bet. And this is becoming, quote unquote, a very famous phrase these days, deep tech. We doubt India is the right market to invest in deep tech, right? And it took me some time. I said, look, can you elaborate, right? And let me just understand this. And clearly, the larger investors, and you need them, right? You need them for this ecosystem to develop, because you may have placed that venture bet on some of these companies, but yeah, you need to sort of hand over the baton to the next big investor, right, who could see them through in the revolution. And then you realize, listen, I, as an early stage investor, was comfortable with a deep tech bet, and the bigger guy who has to kind of see him through for the next 10 years is not. How do you see that problem? And A, have you heard of this? Is it sort of something which you've also picked up? And then do we need different types of investors to come in to help this industry evolve, which, let's say, e-commerce or fintech or edtechs of the world did not see, right? And therefore could be a challenge? Or you think it would sort of start falling in place as more success stories kind of emerge in the market?
Good question, Manish. So continuing with the idea that capital follows businesses and capital follows the path otherwise called as least resistance. See, please understand that ecosystem, venture capital ecosystem, I am only expert in that, has evolved in phases. In 2010, any investment in India would not make sense. Whether deep tech, or, I mean, there's nothing deep tech, but Flipkart, when they raised their first $1 million round, must have been the first of its kind. And then they raised a $100 million round, were first of their kind. And when there's a $1 billion round, also first of their kind. But once Flipkart has built itself, two things happen. One thing is very obvious, which is that people see some success and success breeds success, and therefore more investment flows into that segment. But the other piece is very interesting, where you see that a Flipkart executive at all levels, top to bottom, learned how to build an e-commerce business, were then able to build other businesses which are either allied to them or similar to them. So a delivery happened because of Flipkart, a ship rocket happened because of Flipkart or other D2C brands, and so on. Becomes an entire ecosystem becomes forming, and a lot of learning gets absorbed. Entrepreneurship is still the leading indicator. Like with everything else, an entrepreneur still has to figure out whether the capital investors will support it or not. And therefore, as investors bloom, we have seen phases. There was a phase of B2C, there was a phase of B2B. We were earlier investors in a lot of software companies. At that point of time, no one invested in software, 2011, 2012. Today, you have seen large companies like Freshworks and so on being built out of India, and now everyone is making a beeline. So it is a cycle. It is bound to happen with every sector. With deep tech also it is bound to happen. Like Koushik was mentioning, with EV also it is bound to happen. There is a lot of both learning and proving that has to happen in the ecosystem, and then things will become better. The interesting question is how then, if you know this, as an investor you behave. That is where I think the genius of an investor lies, or whatever limited capability that we have lies, where you are able to then pick the trend or an entrepreneur who will go against all odds and be the first of its kind to prove this. We were investors in deep tech companies in 2012. There's a company called Grey Orange, which is 100 billion revenue into warehouse automation. There's a company called Carbon Clean, which is into carbon sequestration, more than 10 years back. These companies did not have any equal. We chose to invest in them. We have supported them all this while. And now they have crossed $500 million valuation after 10 years. So it does take that kind of time. If we asked ourselves that a second round investor, third round investor, fourth round investor are not going to come in, then this wouldn't happen. If we had taken a view that an Euler Motors will not find follow-on investors, or a Battery Smart will not find follow-on investor, or Yulu, then those companies would find it hard. I mean, I don't think we will make or break them, but will find it hard to scale. But they have, and they're proving it, and hopefully some of them will create ecosystems, and things will happen much better. So, net, as an investor, you have a choice. Sometimes those choices go wrong. And as a founder also, you have a choice to find those people who are a little more experimentative and little more self-belief than others.
Sure. Aparna, as a, a DFI, if I were to ask you to share a DFI or a sovereign funds perspective to this question, and in general, I mean, how you're seeing the EV market evolve and your commitment to sort of, supporting the development of this sector.
Yeah, sure. EV market is something that we are very, very bullish on, and I can say that it's not just BII, but the other fellow DFIs and sovereign wealth funds as well. And as you know, climate tech, I think just overall, environmental, and I think just with those themes, it fits in very well. So I think that is something which is a priority for a lot of these upstream funds as well. And, I do feel that the whole ecosystem will spiral up in terms of the financing from upstream to the funds and then onwards to the companies. And I think just some of these challenges need to be solved. We feel like, especially things like batteries blowing up, and then we feel that the government regulation coming in to some extent would be a good thing. This would really help the consumer sentiments as well as the sentiments of the banks and the funders like us. And I think that would also lead to lesser fly-by-night operators and more serious players. Some level of standardization might be good for the market. And I think, obviously for DFIs like us, like safety and some of these things become like really important, even ESG and other things. So I think the industry overall is headed in the right direction. And also, a lot of these companies which are now trying to develop their own tech with their own R&D and IP, right? They might be very small, the commercialization might still be down the line, it might be something which is not typical for DFIs like us to look in, but I think with, as we go forward, DFIs are also becoming more and more experimentative with their capital and are trying to take such calls which might, which are in line with our mandate and which falls into the green theme, the climate theme, and we do that through funds, we do it directly as well as co-investments as well as direct equity as well. So I am seeing a lot of such activity in sectors like EV especially going forward.
Great, and I'll just have a last question and then I'll open the panel for questions from the audience. But as we all know, there has been some press around product safety and some of these blow-ups that happened. And I'm sure this must have been a very relevant IC question these days for all of you. So how you deal with it? Because clearly, people kind of sometimes also blow these incidents out of proportion, and it also unfortunately then paints a slightly wider brush on the overall development profile of a sector. Any comments, any reaction? Any of you want to just comment on that?
So, batteries catching fire is not new to India. It is not new to anyone in the world. It is bound to happen. Batteries are hard, very difficult thing, and they have to be pampered, to say the least, to make sure they perform very well. At the same time, from a consumer perspective, the consumer confidence will require a very high degree and standardization, very high degree of standards to be followed in quality and safety. To me, it is a hygiene question. It is not a question, just because your battery is safe, you're not going to sell more, but your battery has to be safe. And I think government is already working on the right path towards making the right norms to make sure, and also not just norms, but who owns what liability, whether it's a battery manufacturer or the OEM or the consumer in each case. And once that happens, I think it is a natural evolution cycle. We will actually see a much bigger adoption curve. It is very similar to saying how RBI brought a 2FA on every single digital transaction. And now the transaction actually grown up because the ecosystem is believing far more on this. This is bound to happen. It is, yes, temporarily it does impact, but I'm hoping that the negative view on the sector will disappear as quickly as, because the economics is still strong, people will want to buy it, we just need reassurance.
All right, so with that, let me just conclude the panel discussion. I personally taking home some encouraging views from the panel here, both on the likely evolution on the consumer end of financing. Clearly, there's more proactive effort being made by the banks, but more importantly, what I'm kind of obviously took note of was the play that we may see from some of the new age lenders who may actually spot this as an opportunity to possibly create, for all you know, maybe a new segment from consumer financing perspective. On the funding for some of the businesses that are trying to place their bets and develop products and propositions for EV, clearly we kind of picked up that it's going to be important to kind of develop a moat. This market is going to be competitive. You also heard the views around the importance of, really making sure that the product delivers to the right promise, whether it is safety or the performance specs that we spoke about. Clearly, the investor ecosystem is evolving. We really don't have as wide an investor ecosystem as, let's say, some of the other new age industries have seen. But frankly, there is always a first time, right? And looks like the early bets, maybe the early stage investment bets in this sector have already created the first batch of companies that are looking to raise or just beginning to raise the next round of capital. And there have been some success stories that we all know of. And now is the time for that batch to kind of mature into maybe doing bigger rounds, and possibly very soon we would see some unicorns or bigger companies emerging. So with that, I'll open the this for public questions. Yeah, if someone can just. Yes, sir, please. Yeah, please.
I can speak loudly.
Yeah, you are audible.
Aparna and Arpit. In the battery swapping, because we are talking about the product, and the government is promoting for two-wheelers and three-wheelers in the battery swapping a lot. So in the battery swapping, when the battery is taken out, how much the investors, both the DFI and your kind of investors, is willing to support the OEM on making the vehicle without battery? How much confidence and how much you are currently evaluating those proposals without battery?
So we have a company called Euler Motors which is making vehicles, and there's a company called Battery Smart which is making swapping solutions. Batteries. If there's an OEM who has a good product which works with battery swapping services, I'm sure we will support it. I don't see any reason why we will not do it. If I understand your question is about whether this is a great investment proposition, yes. I mean, I don't think by itself it will make it harder to invest in. Of course, the assumption is that swapping itself should be widely available, and therefore the market size not limited by any standard. It is like, very similar to saying whether a Nokia phone or Xiaomi phone will sell without SIM. Of course it will sell because the network is available everywhere. Therefore there's no limitation. But suppose network was limited to a few pockets of this country, then obviously market is smaller, and therefore expectation on a Xiaomi would be that they will set up the network so that the phone can be sold.
Yeah, I would agree as well. I think for each of these business models to work well, the ecosystem overall has to be evolved also. So this would work in tandem with the rest of the moving parts of your business as well. And those parts are evolved sufficiently enough, then there is no reason to say that one would not consider this business as a good business.
Hello. Yeah, so I have a question for Arpit, primarily, considering that you kind of end up doing a lot of early stage investments. Now, you have a case of Euler. You know, you all have investors into Euler, and Euler is an OEM in the three-wheeler L3, L5 space, right? Now, in the EV ecosystem, the fundamental aspect is that, you know, the guys who have got products done, as in products designed, innovated, manufactured now, they fundamentally don't have takers as buyers who are driver owners who can buy the vehicle, because they have options of larger brands who they can trust for their livelihoods, right? And that leads OEMs to forward integrate and go out and do fleet management services as a logistics service provider to do the full length and hence play the full 360-degree end-to-end game. The fundamental question is that the way in which a product company is seen with its DNA, with its risks involved, with its capital required, are significantly different from a logistics service provider entity, which is a super commoditized market where you have tons of supply side when you go to an Amazon or a Flipkart or a big basket, right? Now, the issue is that I today met with a couple of innovators who have cracked, you know, commercial vehicles, right? Now, the challenge is there is no motivation for the buyer who is a driver owner to go out and buy a new age, purpose-built, super tech product done by a startup where he has to put his livelihood on that when he has a Ashok Leyland and a Tata Motors product available on the table. And similarly for the investor, at the end of the day, he sees significant risk in whether this company will be able to go out. I'm talking about early stage plays, right? Whether this company will be able to go out and build a brand, a product, a go-to-market, after-sales service, blah, 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 right? So fundamentally, what does this founder do who has built a fascinating product? They end up actually saying that I don't have an option but to go out and forward integrate and do the fleet services.
Are you invested in an EV company or EV entrepreneur yourself?
No, so we are a venture building platform working with entrepreneurs to build businesses.
Okay.
Yeah, yeah.
See, I'm sure several people in this audience did not hear about a name product called Boat 3 years back, or a product called Mama Earth maybe 5 years back. And there are so many, sugar, for example, has become quite big. Many of you are already users now. Can you raise hands, any of these newest products, right? Tell me how many of you used an alternate product earlier? I'm sure all of you used an alternate product earlier. So the point is, if there is a customer and the customer is dealing with in a hopefully rational capacity with a provider, it has choices. The customer has choices, provider has choices. It is obviously going to be very hard to compete with large brands like P&G, like for example in the boat market, I'm sure there are large brands like Harman Kardon and so on. There's Sony, right? And they still competed, and they're reasonably winning. So I don't see how a small entrepreneur, a small company like an Euler Motors or an Ather Energy or an Ola Electric will not win that business. It will happen. It is going to be incredibly hard. This business is very hard. The product, the ability to enter is very easy. You can build a prototype with almost no capital, but to then be able to build a product that people trust you is incredibly hard. It sometimes takes 5 years, but so is the business.
So Arpit, I'll just interrupt. So I think a D2C brand in any of the categories you talked about is a discretionary product, personal care product, right? This is a livelihood product, particularly in a commercial vehicle segment. For a moment, if we talk about the investment required to be made by that guy is not in small numbers, right? He has to put in 60, 70, 80K or a 3 to 5 lakh amount or take a loan against it. So the stakes involved are significantly higher for the guy who is buying that product than any conventional D2C product of a sugar or a boat or any of the examples that you talked about, right? So I think you know, my only fundamental question is, as an investor, how do you see that company? Because the companies have no options but to forward integrate and build fleet service companies to be able to, because there's no buyer for a product of theirs today. They have to go out and be a logistics service provider to the end customer with their own product to be able to mobilize outcomes and demonstrate what their product can do. Right?
In my estimate, there are more than 200 brands of two-wheelers in India. And I definitely know that 5 years later, maybe 90% of them will be dead. Right? And hopefully there'll be newer brands. So yeah, at this point of time, we will see a lot of flux we will see a lot of death. And people who will survive, whether by doing logistic services or by selling services to someone else or by raising capital or by bidding whatever, they will survive. And some people will survive. At this point of time, being a two-wheeler OEM, or I would say even a three-wheeler OEM, is incredibly hard. And I will not mince any words. It is going to be very hard to raise capital also. I've written a blog post about it. It is very hard, but I'm sure some of the people who are struggling right now will succeed in 3 or 5 years from now. And I don't know what path they will take, but surely will happen. It depends on then entrepreneurial energy.
Got it. Thanks.
Hi. So my question is, in two parts, and I'll start with the analogy, I think, which Arpit or Koushik, you mentioned, that everybody realizes that financing of the end customer, financing of the electric mobility players, this is critical. Financing is the critical piece. But just like incumbent OEMs, incumbent financiers, banks are also behaving in pretty much the similar way. It's the new age NBFCs who are really leading the charge here, or the opportunity is there. Or these NBFCs are themselves startups. So how do you look at funding these asset-heavy business models? So one thing is your funding thesis on an electric mobility OEM or an electric mobility operator, but how do you look at an asset-heavy play of an NBFC itself, a new age NBFC, which would focus on electric mobility or solar power segments or some such segments? The second part of my question is, I think you talked about Grip Invest, no offense, great innovation that they've done, but there are some risks which need to be regulated. Just like a quality has to be monitored by a new age OEM, similarly a new age lender also needs to not blindly pass on the risks to an individual investor who may or may not understand those risks fully. So there is a bit of regulatory arbitrage, and there is a reason why lending is a regulated industry. So any views on that for the new age NBFCs? How do you see this funding and the regulatory arbitrage play out in the new age NBFC space?
Maybe I can start off with the first part. So when I spoke about new age NBFCs, I wasn't just mentioning NBFCs that do only EV financing, right? There are NBFCs who have built a decently large book on MSME lending, non-institutional lending, right? And have raised decently large amounts of capital, right? There are at least 2 or 3 of them that I know of, and I don't track BFSI so closely, I'm sure there are more, who are looking at this as a separate product class, right? They are decently capitalized. If they divert a part of their, equity capital and lever that up, given the stage the industry is in today, if 4 or 5 of such guys come together, they can, give a significant impetus to the financing market. And obviously there are companies which are much smaller who are looking at EV financing as their primary, business. They will need to raise capital. I mean, they will probably face the same challenges that the OEMs are facing, right? I mean, everyone needs capital, and for them, capital is even more important because capital is their raw material, right? So they would need to go through the same hurdles, but there are also NBFCs that are large enough, have other businesses, and are looking at EV financing as one of the other products.
So on the piece of regulation, I totally agree with you. The regulation, we have to ensure that people who are eventual lenders, individuals, for example, have to be told about the risk. They should be educated about the risk. And currently, there is a P2P lending regulation. I don't know whether it is comprehensive enough for this kind of asset class. So there is no doubt that it has to happen. At the same time, I'm also fully aware that individual lending or HNI lending will be limited in size. And this is not a systemic solution to the problem.
Thank you.
Yeah. No, I think we're talking about risks and you kind of giving a very clear perspective. I'm wanting to understand from an investor's point of view, obviously we know the largest risk in this space is not having enough public infrastructure in terms of the charging stations. And we also know that globally, whether Siemens or ABB or Hitachi, who are the big players, they're taking their own time to kind of come in. That is one piece from the popularization, or maybe scale. Any other risks? What do you folks see? The way we saw in the chip space, India doesn't have a real backup, and we were struggling now in that space. So, and I would say the automobile industry in one way was significantly, and you folks have among the best research teams across the board. So, what do you see as other potential risks beside the charging side and the infrastructure side, which one needs to look at or be aware of as one looks at making funds or investment in this sector?
So on the piece of charging, we have two companies. One is a swapping company called Battery Smart and a charging company called Electric Pay. You're right that the risk involved in setting up a charging network exists because this is like an infrastructure business. It has to be monetized like an infrastructure business. It is a long-term capital gestation cycle, and it has a very unpredictable cash flow at this point of time because the growth itself of the industry itself is unpredictable. On the charging equipment side, I know there are several people like Exicom or Delta, or there's a small company called P2 Power in Noida. Several people are making very high quality charging systems. So I don't see us having a challenge of indigenization or homologation. We will probably don't have to import everything, but I think for the short period of time, we will continue to see that as a challenge. I know that even EESL has deployed Chinese chargers. It is an opportunity bound to be broken by Indian companies. I think several companies are on it. They will get there soon enough. Koushik, you have a view?
If I mean, we've been doing research in this space, and I actually fully agree with you that look, we might be sort of missing the bigger issue forest for basically counting the trees, right? Now, clearly, charging infrastructure is a problem which is here and now, right? If we don't deal with it, we obviously can't progress. But look, I mean, we do believe that there are bigger supply chain scalability related risks that not just in India we have to deal with, but also globally. I mean, we've just seen one, which is chips, but I mean, lithium ion is no less of an issue. If you just total up the total cell manufacturing capacity and then look at with the overall EV adoption across the globe, it's a global industry. It has nothing to do with India, right? You will clearly see that we will run out of capacity, right, very soon. And somebody has to add that capacity, right? Okay, you solve that. You have possibly alternate chemistries. You have newer technologies. By the time we get there, you will see another problem, which is recycling. Who's going to deal with so many batteries that will get junked out, right, of these vehicles? I think this is going to be like a big ecosystem with connected dots, right? And you will be, over a period of time, as strong as the weakest link in this. We are at a very early stage. And again, India is a small cog in the large wheel. We also should not ignore that this cannot work on a standalone basis. You cannot solve this problem thinking about India. Thanks for bringing this. Chip is a great, eye-opener for us in India. We never thought something like this, right? And we all know where bulk of the chip manufacturing happens. I mean, that small capacity issue could actually, take the industry to its knees, right? So thanks for highlighting it. I just wanted to kind of recognize the importance of some of the bigger scalability issues that this industry may face.
I have a very different view on charging. I think it's a grossly overhyped problem. It's a perceived risk, but I'll take 10 minutes from my answer, and I can see Siddharth getting a bit restless there. So we can talk separately about charging infra.
But thank you very much. It was really enriching, and So we've learned a lot, and thank you very much, the audience as well. Round of applause.